Welcome to TS Lombard. Well, we're looking at next year from the vantage point of a new president-elect in the US, and very much focused on what the Trump effect is likely to be. Our bottom line, as we highlight in our monthly publication, is that Trump will be positive for emerging markets, but particularly for emerging market equities. And in particular, this has to be seen in the context that in the last few weeks we've seen a significant sell-off in a lot of emerging market assets. And we view that as an opportunity for investors to increase positions. The biggest question mark with regard to a Trump administration is whether he will get into protectionist kinds of measures, in particular with regard to Mexico and China. I was in Mexico recently, 3 weeks ago, and had some discussions with Mexican politicians, and they're quite open to sitting down and renegotiating or at least updating in their perspective the NAFTA agreement, the free trade agreement with the US. The reality is that it's going to be very, very difficult to change anything in this agreement in a fundamental way because of the growth of supply chains over the past 20 years. And I think in the case of China, we're also not expecting any significant fundamental change. Instead, what we're looking for is perhaps some symbolic actions, such as what we've seen very recently with this carrier plant in Indiana, where the president was on primetime TV claiming credit for preventing jobs from going to Mexico. The reality is not very much is really going to change. There'll be a lot of sound bites, but not reality. So our number one recommendation is emerging market equities. We've upgraded them. We think they look attractive at current valuations. With regard to emerging market credit, and just to remind listeners, we look at emerging market credit relative to US Treasuries. We think the outlook still is good because we think investors will be continuing to search for yield, and emerging market credit certainly gives investors that yield. The outlook overall, we think next year will be one of rising interest rates. We expect the Fed to hike the Fed funds later this month. And we've already had a strong dollar, but we're not expecting that it's going to get much stronger from current levels. So in that scenario, our top pick is number one, emerging market credit. And secondly, we have a positive view on emerging market credit, i.e. dollar bonds, but hedged with US Treasuries. As we look at specific calls, on the equity space, we have moved up as our top call as a strong positive Russian equities. This is not only because of attractive valuations, but in particular because of likely political developments. We saw François Fillon win the center-right vote last weekend, and both Fillon and Marine Le Pen are in favor of loosening sanctions against Russia. So we think that the political stars are aligning in a favorable way for Russian equity. So that's our top pick on the equity space. Other changes that we've made on equities, we've cut India, and as we explain in our write-up, this is really out of the total confusion that's been caused by the demonetization initiative on the behalf of Prime Minister Modi. Looking elsewhere, we've upgraded virtually all of our positions in South Africa. And this is a reflection of the fact that President Zuma appears to be losing his influence. And we translate that and we say basically that the two key institutions, the Reserve Bank and the Treasury, are not facing threats to change policy. And so we think that's very positive. We think the currency's undervalued, so we're expecting a gradual appreciation of the currency. We like local rates, and we've also moved our equity call to positive. Now, some of our negatives, Brazil in particular, we've taken a negative call on the currency, and that really is reflecting the recent dislocation, political dislocation that President Temer has gotten himself into. So we've become more bearish on the outlook. We've lowered the equity outlook to negative, and we think that 2017 is likely to be a lost year for the Brazilian economy. Other negative views, just to highlight in passing, Turkey, we've got a negative view on the currency, local rates, and equities. However, we think that Turkish dollar bonds, after widening out quite substantially, are probably a safe investment. Well, that's it for this month. Looking forward to visiting with you again after the first of the year, and have a very good holiday, and best wishes for the new year.